Investing is the act of committing money or capital to an asset with the expectation of generating a return or profit over time. Unlike saving, where money is set aside for future use, investing involves taking on some level of risk in hopes of earning a financial reward. Investing can take many forms, such as stocks, bonds, mutual funds, real estate, and more. The primary goal of investing is to build wealth and secure your financial future. Investing is inspired by the thought that Investing is essential for growing wealth because it outpaces inflation and offers the potential for higher returns than traditional savings methods. While saving money in a bank account is important for short-term goals and emergencies, investing allows you to generate wealth over time. With inflation eroding the purchasing power of cash, investing helps ensure that your money works for you, increasing in value rather than stagnating. Tip: there are several different types of investments, each with its own set of characteristics, risks, and rewards. Common investment options include stocks, bonds, real estate, mutual funds, exchange-traded funds, ETFs, and commodities. Each investment type serves a specific purpose in a diversified portfolio, helping balance risk and reward. Understanding the differences between these assets is critical to making informed investment decisions. All investments come with some level of risk. Risk refers to the possibility that the value of an investment may decrease, resulting in a loss of money. Different types of investments have varying degrees of risk. For example, stocks tend to have higher volatility and potential for greater rewards, while bonds are typically considered safer but offer lower returns. Understanding your personal risk tolerance is essential for building a portfolio that aligns with your financial goals and comfort level. Risk tolerance is the level of risk you are willing to take with your investments. It is influenced by factors like age, income, financial goals, and personal preferences. Younger investors may be more willing to take on risk, as they have time to recover from market downturns, while those closer to retirement may prefer safer investments. Understanding your risk tolerance helps shape your investment strategy and ensures you make decisions that align with your financial goals. Diversification is a strategy that involves spreading your investments across different asset classes to reduce risk. By diversifying, you avoid putting all your eggs in one basket, which can help mitigate the impact of a poor-performing asset. A diversified portfolio typically includes a mix of stocks, bonds, real estate, and other investments, balancing higher-risk assets with more stable ones. Diversification increases the likelihood of earning a return, as different investments perform differently under various economic conditions. Stocks represent ownership in a company and give investors the right to share in the company's profits and growth. Investing in stocks can provide high returns, but they also come with a greater degree of risk, as stock prices can fluctuate due to company performance or market conditions. Long-term investors often buy stocks in companies with solid growth potential, as stocks tend to appreciate in value over time. However, it's important to research the companies you invest in to make informed decisions. Bonds are debt securities issued by governments or corporations that pay investors a fixed interest over a set period. When you invest in bonds, you are essentially lending money to the issuer, and they promise to repay the principal plus interest. Bonds are considered safer than stocks, but the returns are usually lower. They are an attractive option for conservative investors looking for steady income and lower risk, especially when compared to the volatility of the stock market. Mutual funds and exchange-traded funds, ETFs, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are actively managed by fund managers, while ETFs are passively managed and typically track a specific index, such as the S&P 500. Both offer the benefit of diversification, and are ideal for investors who want a more hands-off approach to investing. They also provide access to a broad range of assets without requiring the investor to pick individual stocks or bonds. Real estate investing involves purchasing properties to generate income through rent or capital appreciation. This type of investing can provide steady cash flow and long-term wealth, making it a popular option for those looking to diversify their portfolios. Real estate also serves as a hedge against inflation. However, it requires a significant initial investment, and the market can be influenced by factors such as interest rates, property demand, and location. It's important to research the market before committing to a real estate investment. Investment accounts like 401ks and IRAs, individual retirement accounts, are designed to help individuals save for retirement while offering tax benefits. A 401k is typically offered by employers, while IRAs are individual accounts that anyone can open. Both types of accounts allow investments in stocks, bonds, and mutual funds, but with tax advantages. For example, contributions to a 401k are made pre-tax, lowering your taxable income, while Roth IRAs offer tax-free withdrawals in retirement. Understanding these accounts can help you plan for a financially secure retirement. Compound interest is one of the most powerful concepts in investing. It refers to the process where interest earned on an investment is added to the principal, and then the interest is calculated on the new, larger amount. Over time, compound interest accelerates the growth of an investment, making it an essential tool for long-term wealth building. The earlier you start investing, the more you can benefit from compound interest, as it gives your investments time to grow exponentially. Dividends are periodic payments made to shareholders by companies that share a portion of their profits. Investing in dividend-paying stocks can provide investors with a reliable stream of income in addition to potential capital gains. Many long-term investors focus on dividend stocks as a way to generate passive income while benefiting from the growth of the company. Reinvesting dividends is another way to take advantage of compound interest and accelerate the growth of your portfolio. Before making any investment, it is crucial to conduct thorough research. This involves studying the asset, understanding the market, evaluating potential risks, and considering the investment's alignment with your financial goals. Research helps you make informed decisions and avoid common pitfalls, such as investing in high-risk assets without fully understanding the potential downsides. Whether you're investing in stocks, bonds, real estate, or other assets, research is key to successful investing. Active investing involves making individual investment decisions based on research and analysis, with the goal of outperforming the market. Passive investing, on the other hand, focuses on buying and holding investments for the long term, often through index funds or ETFs, and aims to match market performance rather than beat it. Both strategies have their advantages and disadvantages, and the choice between active and passive investing depends on your financial goals, time commitment, and risk tolerance. Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. This strategy helps mitigate the risk of investing a large sum of money at the wrong time, particularly during market volatility. By buying investments consistently over time, you lower the average cost of your investments and reduce the impact of market fluctuations. Dollar cost averaging is especially effective for long-term investors who are focused on steady growth rather than short-term gains. The stock market moves in cycles of growth and decline, known as bull markets and bear markets. A bull market is characterized by rising prices and economic optimism, while a bear market is marked by declining prices and pessimism. Understanding these cycles can help investors make informed decisions about when to buy or sell assets. It's important to avoid making impulsive decisions based on market fluctuations and to stay focused on long-term financial goals. Investing has tax implications that can affect your returns. Capital gains, or the profit made from selling an investment, are subject to taxes, with rates varying depending on the holding period. Long-term capital gains, for assets held over a year, are typically taxed at a lower rate than short-term gains. Dividend income may also be taxed, but the rate depends on whether the dividends are qualified or ordinary. Understanding these tax rules and using tax-efficient strategies can help maximize your investment returns. An investment portfolio is a collection of different assets chosen to align with your financial goals, risk tolerance, and investment strategy. Building a diversified portfolio involves selecting a mix of stocks, bonds, real estate, and other investments that complement each other. Diversification helps minimize risk and maximize potential returns. Over time, as market conditions change and your financial goals evolve, it's important to periodically review and adjust your portfolio. Inflation erodes the purchasing power of money over time, which is why investing is important for protecting your wealth. If your investments don't outpace inflation, the value of your money will decrease over time. Stocks, real estate, and other assets have historically provided higher returns than inflation, making them good choices for long-term investors. Depending on the state you live in, understanding the impact of inflation helps you select investments that offer a real return, ensuring that your money grows faster than the rate of inflation.